Assalamualaikum warahmatullahi wabarakatuh. Good afternoon, sir and friend. Today we are going to present our presentation group. It's about capital budgeting by group 13. There are two members. The first is Elfa Yulines and the second is me, Farel Pafinakiga. Next. And we have 6 learning objectives. And for the first learning objectives will be presented by Elfa Yulines.
Okay, thank you, Farel. First is fixed asset acquisition. Managers are frequently faced with a choice on acquisition of additional equipment and replacement of old equipment. The other principle of SOPAN should all be applied to. The principal tax consideration. U.S. federal income tax. The depreciation tax derives from the modified accurate cost recovery system provide the primary tax incentive. Other federal tax incentives include a 20% tax credit for incremental research and development or R&D expense, and a welfare to work credit. Foreign income tax. Many of these incentives were discussed in Chapter 8. State and local tax. For depreciation, most states have adopted the federal accurate cost recovery rules. Most states also offer enterprise zone incentive. An enterprise zone is a local with a very depressed economy. The incentive equals a sales tax reduction along with a credit for equipment purchase and wage paid. Incentive rank from tax credit to tax holidays to bargain access to land, buildings, equipment, road, sewers, utilities, or municipal service. And the last, sales tax. In most jurisdictions, capital acquisition of personality, such as machinery and equipment, are subject to sales tax, like Germany's value-added tax and Canada's good and service tax. Most of the states in the United States impose a sales tax on retail sales of tangible personal property by instead vendors. This is a picture about using a leasing company to defer tax. In this picture, the first transaction is not subject to sales or use tax because it is a purchase for resale. The second transaction is subject to sales or use tax, but over time, payments are made. Thus, the tax saving from flow from the reduced present value of tax cost. This is an example of timing. Do analysis from a certain perspective. One strategy. Any equipment acquisition so make business sense independent of tax consequence. The firm should first consider strategic aspect. Consider an express delivery business where most of productive assets are delivered. Consider the impact if the U.S. government and the state by conformity to the federal change to the 3-year useful life category. To anticipation or timing. If the tax laws on depreciation change, so this should affect the timing of transaction. This especially is the case for year-end and acquisition. If new laws are about to make the tax depreciation more rapid, firms should anticipate the change by evaluating whether delaying acquisition until the beginning of the next tax year makes more sense. If a manager expects change in tax law, then the year in which the assets are acquired should be adjusted. There are potential effects for change both in tax rate and in depreciation method. Negotiation. Mergers and acquisition can involve negotiating tax benefit where, as is typically, a large acquisition is made from one vendor. For value adding, a project that has a positive net present value will also increase firm earnings based on performance measure. such as earning per share and economic value added. However, their collateral financial statement effect to be considered. In the short run, bonus may decrease due to increased financial statement depreciation, especially if bonus are tied to pre-tax earnings. In evaluating whether a project has a positive value added, transaction costs should be considered. Involved are items such as information acquisition costs, title transfer fees, document tax and commission, and professional fees if an entity is acquired. Three, putting it all together, seven concept applied to capital budgeting. This is a case. You are the chief financial officer for a major overnight delivery service. You are considering replacing your aging fleet of aircraft, Boeing 747, with new aircraft Boeing 767. You need 20 of these aircraft, which cost is 10 million per each. You can receive 250,000 each after tax on the sale of each all aircraft. Due to increased fuel efficiency and decreased maintenance, you expect to save 2 million per year per aircraft over their 10-year useful life. Your cost of capital is 8%. As a 7-year March useful life, a federal tax bracket of 34%, a state tax bracket of 8%, and the state conforms to federal merger rules, and a state sales tax rate of 7%. Strategy. If the project has a significant enough positive cash flow, maybe we able to drop delivery price. Also, there is a promotional advantage to having a new aircraft. Customers may believe that our new fleet is more reliable than that of competition having older aircraft. Negotiating. Because Boeing is in a high tax bracket, it may prefer to lease their aircraft to you and recognize income ratably over time. So a lease purchase agreement is for whereby you, based on your intent to purchase the aircraft, treat it as a capitalized lease purchase. This saved Boeing 5 millions in this context, half of which the company may be willing to pass on to you in the form of lower price. Also, under a lease, the sales or use tax that you will have to pay will be made relatively over time. Value adding and anticipation. If the lease is cancelable by the lessee, it actually is less risky than an outright purchase, assuming the aircraft are reliable and your customer base is unlikely to decrease. Although technically Boeing could cancel the lease, you believe this is unlikely to occur. You also expect no change in the tax rate or depreciation rules, so accrediting or otherwise adjusting the timing of acquisition is not required. What of the effect on the firm financial? On the balance sheet, the agreement can be treated as a capitalized lease, so both asset and long-term liabilities increase by the present value of the lease payment. The next slide will explain by Farrell.
Okay, thank you, Ines. I will continue the presentation. The next is make or buy decision. Manufacturing companies are often faced with the decision to make or purchase components that are integral to the manufacture of their product. The advantage of in-house manufacturing is complete control over time and product quality. However, outsourced components, especially if they're manufactured in a low-cost country, can be cheaper, and especially if there is a competition in this market. Whether it's cheaper to buy outside or not depends in part on the overhead costs that can be avoided. Avoidable overhead are costs that would not be incurred if components were outsourced. The decision to make or buy is a costing decision and is also influenced by many general factors, which are as follow. The first is availability of financial resources. The second is investment required in fixed assets. The third is availability of skilled and unskilled labor. The fourth is availability of supplier. The fifth is existence of idle capacity in organization. And the sixth is price at which the product is available in the market. And the last is other miscellaneous factors. Next. As you can see in this example, there are direct labor that the price is $100, and the next is direct material that the cost is $100, with the overhead in direct material as $30, and then factory utilities, insurance, and taxes are allocated in the $70, which will conclude it in the $300. Because the $70 is not available, the real cost to manufacture internally is $230 before the transaction costs. Tax-related transaction costs may be important if the manufacture or purchase is across tax jurisdiction. If the good is manufactured by the firm in a different state, stopping manufacture may mean that the firm nexus with the state will disappear. This will eliminate allocation of the firm's income to the state. If this state has higher tax rate than the average from the firm rest of the operation, cessation of manufacture result in a negative transaction cost. Next. And the fifth is capital budgeting and plan capacity. If the firms need to expand plan capacity, it may do so by expanding the current plan or by building additional and also separate facilities. Because of the interrelationship of federal, international, and state and local tax in many businesses, it is important to consider all of these taxes. There are 4 taxes with difference located in the expand existing plan and also in the build additional facilities. All of the 6 consist of property tax, income tax federal, state and local, and also the last is foreign tax. Next. And the last point is risk consideration. Because capital budgeting involves longer run horizon, there is inherently more risk that cash flow may vary from the projection. Because income taxes decrease revenue, they act as a variant and hence risk reduction mechanism. As we can see in the exhibit 11.5, it is the impact of tax on project cash flow. Next. And for the example, as we can see in the picture, there are 3 cases. For the worst cases consists of 25% probability. For the most likely case consists of 50% probability. And for the best case consists of 25% probability. As we can see in the worst case scenario, a possibility of $11 million per tax loss is converted into a 70 million and 200,000 after tax loss. If the company cannot afford the former loss or a manager's evaluation hangs on the investment, taxes can actually help in a risky capital budgeting project. However, if the loss creates an net operating loss at the entity level, the effect of that income taxes can make the loss as palatable. This is because of net operating loss restriction in most states. This same applies to many countries that can be in the 3 cases: worst case, most likely, and best case. Okay, this is the last slide. Thank you very much for your attention. And that's all about our presentation about capital budgeting. And if there is any message, we say sorry. Thank you very much and good afternoon. Assalamualaikum warahmatullahi wabarakatuh.